Hello, and welcome to another class by Professor Choi. Today we're going to be talking about what is economic growth, the financial system, the business cycle, and basically putting a lot of information together. Now, the business cycle are basically alternating periods of economic expansions and economic recessions that we have been able to measure since the market system has been around. In previous chapters, we covered already what the business cycle is, but just in case as a refresher, if we do a relationship between time on the horizontal axis and economic activity as measured by real GDP over time, we see this pattern of increasing economic activity followed by a decline in economic activity followed by an increase in economic activity. Every time we kind of are on the increased portion of the cycle of economic activity, we call that an expansion. During an expansion, you're going to notice that real GDP increases. You're going to notice that unemployment declines. You're going to notice an increase in income. You're also going to notice slight increasing inflation. And basically, this is a good part of the cycle. This is the one that people want to live in. You could call it, the 1990s, 2001 to about 2008 or so, and the decade preceding the recession of COVID in 2020. Eventually, you hit a peak, and when you hit a peak of economic activity, we go into a slowdown. A slowdown is called a recession. And during a recession, the economy is shrinking. We're going to notice because real GDP is going to decline. Unemployment will rise. You'll see a decrease in income. And you'll see a decrease in inflation. And possible deflation. Now again, during an expansion, you would also see asset prices go up. And during a recession, you will see asset prices decrease. Now the recession eventually ends. We hit a trough. And then the period right after the trough is a time where we're not sure how things are going. So we're not 100% sure if things are getting better, they're not getting better. Some of the data is telling you that it is, some of it is not. We call this period the recovery. And once we have hit the previous number of the previous peak, then we start calling it an expansion again. Okay, so these are basic cycles that a market system goes by. We have plenty of recessions in the past. If you want a whole list, this is a pretty comprehensive list of US recessions in the past, all the way back to the 1700s. And these are the latest ones. All right. Now, how do we achieve long-run economic growth if we know that you have periods of expansion followed by periods of recessions. Doesn't that mean that you go up, then you go down, and then you end up in the same place that you did before? Well, it would if that was the way that you would actually see it today, but that is not what we see today. What we see today is more of a increase in economic activity followed by a decrease in economic activity, but the trough is usually higher than the previous trough, and then we continue to go up, and then the next peak is higher than the previous peak. And that's how you know that you're having economic growth over longer periods of time. In other words, the next peak is higher than the previous peak, and the last trough is lower than the new trough. All right. If you look at the US economy in the last 60 years or so, we have been growing at an average of about 3.3%. And this is the average growth rate of real GDP. This average has slowed down, by the way, in the decade of the 2010s or so. Now, this is a graph showing you long-run economic growth over time. As you can see, this used to be real GDP per capita in the 1870s. Real GDP per capita, by the way, is real GDP divided by the amount of population in the country. So this number takes into account increases in population as well. So we have seen a rapid expansion on real GDP per capita basically since the 1940s. All right. Now let me show you another website that will give you some good data about this. I really like this website because it has all this really cool information, statistical information, and we get to see it, and we can use time as one of the variables. So you can actually change things. So if you come down here, it says income, we can change it and put time there. And we can put income on this side. And what you see right here is all the incomes of all the different countries. So this income per capita, using real GDP per capita as the metric for that, for all the countries in the world today. Now let's put the United States here. We can also follow, for example, China. And if you're interested, Professor Choice from Cuba. So here's Cuba. Okay, so if you look at the year 2019, income per capita in the US is about $56,000 per person. China's income per capita is about $17,000 per person. Cuba's income per capita is around $7,230 per person. Now, one of the cool things about this website is that we can actually go back in time and now that we've gone back in time, we can look at the same thing. So if you look at in the 1800s, in the United States, income per capita used to be somewhere around $1,980 per year. In China, it used to be about 902. Sorry, this is Cuba. And in China, it used to be about $736 per year. Okay, now let's click on play and see how income per capita has changed. Again, this is income per capita in purchasing power parity, inflation adjusted. So this is adjusted for inflation and adjusted for population. Okay, let's click on play. By the way, the size of the ball represents the size of the population of that country. All right, let's stop it somewhere on here. Actually, let's go back Go back to about the 1980s or so. So this is 1976. If you look at the US between the 1800s to about 1977, our GDP per capita increased quite significantly. If you look at China, though, their GDP per capita was about the same as it was 170 years before. This is one of the reasons why we talk about China and India and a lot of countries in Asia, is because since the 1980s they have been basically able to get out of the bottom of the world. As you can see here, these are all the countries in the world, and you can see that China basically is right around the bottom on GDP per capita. All right, now again, let's click on play and see this miracle happening. All right, notice again the list of all the countries in the world. So this is GDP per capita in all different countries in the world. And as you can see, since the 1980s alone, China has been able to take their population from the poorest in the world to about middle class. Middle class, about the middle, you can see, in the world. Okay? Now the US has continued its increase. So the US is still at the top. We're top 5% in the world. And it's $56,700 a year. All right, another metric that will tell you that we're doing better over time is literally a simple thing like life expectancy. If you go back to the 1800s, life expectancy in the US was 39.4, in China it was 32, and in Cuba it was 32. Click on play. Notice that in the 1800s, not much changed. And then somewhere around the mid 1800s, you start seeing an increase in life expectancy. All right, notice now that all the countries in the world are moving up. This is the 1950s. And this is what we have today. By the way, in case you didn't know, this video was done in 2020. And as of 2019, 2018, 2017, US life expectancy is actually slightly in decline. Okay? So it's no longer growing. As you can see, we peaked at around 78.9 in the year 2012, and it's been stuck there. It's dropping a little bit. Okay? The rest of the world, as you can see, though, is right around the same average. All right, so that'll give you an idea that, in fact, we have been growing and getting better over long periods of time. Now, these graphs right here will also give you a bit of an idea with that. So this is a comparison of life expectancy between the 1900s and 2008. This right here is a lifetime working hours number. As you can see, life expectancy is significantly higher in most places in the world. Look at India. It's almost 3 times as high as it used to be 120 years ago. Notice also that we actually have more leisure time. See this yellow? It's getting bigger, and the work hours is actually getting lower. We're also spending more time driving, by the way. This right here is discretionary hours. All right, let's talk a little bit about something called the rule of 70. The rule of 70 is basically a guesstimate of how quickly a GDP will double in size. So it's basically a guesstimate for how quickly it will take for a country's GDP to double. Now, how does it work? Well, let's say that your economy, your real GDP, is growing at around 5% a year. Okay? So, and let's say that you have a GDP of $10 trillion. What the rule of 70 basically says is that it will take 70 divided by 5 years to go from 10 to 20 trillion. So if you do 70 divided by 5, it will give you a guesstimate for how quickly your country will go from 10 trillion to 20 trillion. Let's pull our trusty calculator. So 70 divided by 5 is 14. Okay, so according to the rule of 70, it will take around 14 years for the GDP to go from 10 to 20. Now, what determines long-run economic growth? Well, the most important thing that determines economic growth is labor productivity. Labor productivity is the most important metric for growth, for income growth, for pretty much anything. Economic productivity in the country is the most important economic metric. It's also one that doesn't change very rapidly. It stays very steady over time. Capital availability, it's also important, the amount of machines, tools, and equipment, because the capital enhances human potential. If you can think about teaching a class without the internet or without access to data immediately or things of that sort, versus what we have today, where you have access to all this information instantaneously, it is a much advanced class. And the difference is we now have machines and software and computers and stuff like that, all of which we call capital. So we have more capital available. Another thing that changes your long-run growth rate is technological changes or technological increases. Technology usually makes you more productive. And I'm not specifically talking about cell phones and iPads, but instead I'm talking about anything that technology usually does, because the majority of technology is usually used to enhance some kind of production at some point. The availability of entrepreneurs in society and the right to private property in the country. Another thing that you need to have to have a well-functioning market system is a very healthy financial system. One of the things that happens in society, especially in a market system, is that money is accumulated by groups of people at some point. Let's call them savers. Okay? And these savers we need to figure out a way to move this money from these savers to whoever needs it on the other side. Let's call them borrowers. Now, who are these borrowers? Well, these borrowers are corporations that need the money to make it into cool stuff. Companies like Tesla, or companies like Netflix when it came out. All right, or any sort of company that wants to that needs the money in order to kind of do what they do. We need to figure out a way to move the money from those savers to those borrowers, and that's really the job of the financial system. Okay, the financial system basically provides this connection between borrowers and savers. Now, there are two basic ways to transfer money in the financial system. One way is what we call the indirect way. And indirect basically involves you conducting a transaction with a regular bank. So this is where commercial banks come in and non-profit banks, also known as thrifts. Okay, so indirect finance is one way to do it. You deposit your money on the bank, you open a savings account or checking account, and then they move the money to the other side by issuing credit cards or personal loans or student loans or mortgages for houses, for example. Another way to transfer the money is through something like a stock market. So what we call direct finance. Now, if you participate in direct finance, they usually, instead of calling you a saver, they call you an investor. And on this side, you're usually dealing with other types of banks, which I like to call brokers. Most people call it Wall Street. Okay? So direct finance is another way to move the money from savers to borrowers. All right. Now, a financial intermediary is a company that does that. And an intermediary is people like corporations like banks or mutual funds or pension funds or even insurance companies that you deposit a lot of money on them and they use that money to lend it to other people by buying their bonds. Banks that place loans from savers and move the money, and mutual funds that sell shares to savers and use the money to purchase securities. Now, the financial system helps savers and borrowers at the same time because it provides income for savers, aka interest, on your CD account or money market account, or maybe on your investments or on your retirement account. And it also provides the ability for borrowers to have a place to go borrow money if they need it. The financial system provides risk sharing, so there's lower risk for each individual security in the system. It also provides liquidity services, so you can turn transactions into cash more easily. You can also make transactions basically seamlessly. I want you to think about a transaction in the 1800s when the banking system wasn't as developed as today, or you couldn't write a check or send somebody money with cash out, okay? And how things used to be different at that time. So the financial system provides liquidity services, and the financial system also provides information, okay? It allows borrowers and savers to have better access to information to make decisions for with their money. Let's talk a little bit about the connection between GDP and savings. Okay. Now, in order to understand this, you need to remember that formula for gross domestic product before. So you need to remember that gross domestic product, which is the total production in a country, is equal to C plus I plus G plus net exports. Now, in order to simplify things, let's just talk about what we call a closed economy. A closed economy is basically when you just talk about the other portions without talking about foreigners. And that's just to simplify things, to understand where savings come from and what do they do. All right? So gross domestic product, which is the total production in a country, is equal to consumption plus investment plus government spending. And as I said, that's in a closed economy. In an open economy, you also have to add exports we usually use an X for exports, and then you gotta subtract imports. We usually use an M for that. And this is what we call net exports, or XN, or some books use NX. Okay? So in a closed economy, this is what you have. And in an open economy, you have this plus that being your GDP. Okay? So this is a closed economy. This is an open economy. All right, so let's focus on a closed economy and let's talk about income. So these right here are expenditures. But remember, if this is you and you send the money to somebody else, it's called an expenditure for you because you're giving it to them, but it's called income for them because they're receiving it. So basically, everyone's expenditure in a closed economy is someone's income as well. So we can say that GDP is equal to not only all the expenditures in the US, but also all the income in the US. And it's equal to C plus I plus G. Okay? Now, when you receive income, you have two basic things you can do with it. So when you receive income from somebody, again, it's expenditure for somebody, but it's income for you, then you have two basic things you can do with it. One thing you can do with it is you can consume it. So you put it right back into economic activity and it gets sort of recycled. Okay? So it gets spent, becomes income, then it becomes consumption. Another thing you could do is you can save it. All right? Now, this is where it gets interesting because savings are crucial for economic activity. The reason they're crucial for economic activity is because savings is what we then use in the financial system, either indirectly or directly, to move it to the people who need it, these borrowers. And who are these borrowers? Where the biggest borrowers are investors. These are the corporations that need that money. So savings are necessary for the creation of credit. And credit is extremely important for the creation of factories and machines and technology, etc., etc. All right. So we need to talk a little bit more about the role of savings in the economy and where do they come from. All right. So national savings. There are two basic entities when you look at the breakdown for GDP that can save. One is individuals and the other one is the government. So you could have public savings, aka the government, or private savings, aka individuals. Now, the government, in order for them to have savings, they got to run on a budget surplus. So we need to talk a little bit about the government budget. Now, the government, remember, doesn't sell anything. So basically, the way they make money is by collecting taxes. If the amount of tax collection by the government is the same as the amount of government spending, then the government is running on a balanced budget. If the government is running on a budget deficit, what it basically means is that the level of government spending is greater than the amount of taxation. If the government is running on a budget surplus, then the amount of taxation is greater than the amount of government spending. All right, so to visualize that again, remember G and T, okay? So the government receives T. This is income for the government. They collect taxes. Then the government spends money. And that's what that G here is, okay? So the government spends money. If the amount that they spend and the amount that they collect is the same, then the government's running on a balanced budget. Okay? Now, if instead the amount of government spending exceeds the amount of taxes, then the government is running on a deficit. Every time the government runs on a deficit, they will need to borrow money, and they borrow money by using what we call treasury securities. All right. Now, of course, the more you borrow, the more national debt you have. So running on a deficit makes the country have a national debt, and it makes it increase very rapidly. If instead the government has more tax collection than they spend, then the government's running on a surplus, and they can take some money and pay off that debt. So debt can drop. All right. Now, when the government has a deficit, it has to borrow money. Therefore, it has to issue what we call U.S. Treasury securities, which are basically U.S. government bills, treasury notes, or treasury bonds to finance its deficit. If you're interested in learning a little bit more about the national debt, here's a website. Okay, this is a website that keeps track of U.S. national debt in real time. Now notice, by the way, this video was done on April 2020, and because of the stimulus plans that we just approved in Congress to get out of the COVID-19 recession, the U.S. deficit has now exploded to the largest ever in history. Okay, this is higher than it was during President Obama's administration. This is the highest U.S. national deficit in history. Now, what exactly is a deficit? Well, this right here is the amount of tax collection in the U.S. today. This is the amount of government spending today. And the deficit is the difference between those two numbers. All right, let's talk a little bit about what happens to money and interest rates using the market for loanable funds. Now, the market for loanable funds is just basically like a supply and demand for loans. So over here we have interest rates, which is the price of a loan. So it's the price of borrowing money. Okay, and on this side we have the quantity of loans available, which again, remember, we just use the letter Q for quantity. So in the market for loanable funds, we have a supply of loans, and we have a demand for loans. And the interaction between supply and demand of loans determines the price you can get a loan at. So it determines the interest rate available, equilibrium interest rate, and it determines the quantity of loans available, equilibrium quantity of loans. All right. Now, I don't want to get too complicated on this particular chapter, but basically, private savings and public savings is on the S side. So we have either the government or the consumer that decides to save money. And then on this side, we have the investors that usually are the ones that demand that money for their investments. Now, what would happen, for example, if the government decides to borrow more money? So if the government deficit increases, then what that's going to do is it's going to make the supply line shift to the left. When the supply line shifts to the left, through market equilibrium forces, you're going to notice that we go from supply 1 to supply 2, and there should be an increase in the level of interest rates. And there's a decline in the quantity of loans available. All right, so an increase in the government deficit lowers supply of loanable funds, increasing the price of a loan and lowering the quantity of loans available. Okay, now these assumptions will be correct if we would allow interest rates to float and quantities of loans to float. The reality of the matter today is that we actually don't let that happen. As a matter of fact, the Federal Reserve is an integral player in all of this, and the Federal Reserve likes to control today as part of what we call monetary policy. They like to control the level of interest rates. If you're interested in learning a little bit more about the Federal Reserve, I already have another video about them. You should watch that one. All right. But in a very basic way, the Federal Reserve can change this supply of loanable funds by either pumping money rapidly into the economy or taking the money out of the economy. And therefore, the market for loans is not really free floating in the US. It is much more controlled by the Fed or the Federal Reserve. All right. Now we do have to talk a little bit about this problem of what we call crowding out effect. It doesn't show up in the US too much, but it shows up in small economies all the time. The crowding out effect is this problem that we just talked about here. Every time the government borrows too much money, they crowd out private investment. So you are substituting public expenditures for private investment. And a lot of the times, private investment is the one that's going to create longer term positive effects in your economy. Public investments sometimes don't do that. So every time the government runs on a higher deficit, it creates this problem between money being transferred to public investment versus private investment. And you have to be mindful of that, especially in smaller economies. All right, now in this following slides, we're going to try to connect that business cycle. So the business cycle are basically fluctuations in real GDP and in the level of economic activity through time. The expansion phase, also known as a recovery, is the time where production increases, employment increases, and income increases. Then you eventually hit a peak, and the expansion ends, and you go into a recession phase. During the recession, production, employment, and income tend to decrease. Eventually, we hit a trough, and that is the lowest point on the recession. Now, this is what we call let's call it a classical business cycle, and this is the business cycle in the U.S. using real GDP. As I was explaining previously, most recessions in the US are not very bad. They're just sort of a flattening of real GDP. The one in the year 2020 seems much, much deeper than this. Much, much deeper. All right. Now, this is a graph of the recession of the year 2008, 2009, and we're calling it the Great Recession at this point. Notice, by the way, that some of this information is provided by Pearson Education. All right. So this recession was pretty deep compared to the regulars that we have, but nothing compared to what we're currently already experiencing in the year 2020. The amount of job losses that we had at the worst of the recession has already been experienced within 1 month in the US. Now, who's in charge of saying that we're in a recession or not? Well, the entity in charge of that, it's called the National Bureau of Economic Research, and it's really a private research group in Cambridge, Massachusetts. So they are the ones who declare a recession or not. Now, they already have a kind of definition for a recession, and the definition for a recession is 2 consecutive quarters of real GDP decline. So what we call a recession is 2 or more quarters of real GDP decline. And remember, a quarter is 3 months in the economy. Now, one of the things that you'll usually be tested on in your class is what exactly are the relationships between the positions in the business cycle and the data points that you see out there. Because in order to identify where are you on the business cycle, you have to look at the data that's being provided to you by the economy. So during the expansion, you're going to notice that CPI is going to increase. You're going to see an increase in income per person, and you're going to see unemployment rates decrease. During the recession phase, you're going to see an inflation rate decrease or maybe deflation. Income tends to decrease, and the unemployment rate tends to increase. All right. Notice that there has been a change in the length of expansion versus recessions. So if you go back to the 1870s, between 1870 to the 1900s, expansions lasted about 26 months, followed by recessions that lasted about 26 months. So if you go before the 1900s, we have this sort of classical recession behavior. Between the 1900s and the 1950s, expansion started lasting longer, about 25 months, and recession started lasting less, about 19 months. Between 1950 to 2001, expansions averaged about 61 months and recessions lasted about 6 months. The expansion that we just experienced between the year 2009 and the year 2020, before the COVID recession, is the largest in US history in length. Okay, so this is the largest expansion in US history, 10 years and 9 months before the previous recession. Now, why do we tend to be more stable generally? And by the way, this portion here you have to take with a caveat, with a little bit of a salt, because in the 2020 recession, the stability, the things that have created stability before are also the things that are creating the deepest recession we have seen in a really long time, at least the fastest. And that is the fact that we are a very service-driven economy. Because the majority of the people in the US provide services, and a lot of services require face-to-face interactions, then because of the COVID-19 pandemic, the recession that was created by the isolation of people or the social isolation measures has hit hard, extremely hard, the service industry. And because we have a service industry, before we used to be isolated from shocks, because the majority of services usually don't tend to be affected too much on a classical regular recession. But in the type of recession that we are having in the year 2020, a pandemic, a virus pandemic, definitely services seem to be a weakness, not a strength in this particular recession. Now, another thing that creates a more stable economy is the fact that the economy has unemployment insurance. The government has unemployment insurance, and therefore we transfer money directly from the government into people's pocket very quickly. So it doesn't allow anyone who's unemployed to lose all of their income from something to zero. Imagine if we did not have any unemployment insurance. The federal government also seems to be very active, usually, with these policies of stabilization. After the Great Depression, the government has played a much active role in the economy, and as a consequence of that, the recessions have become less lengthy. If you're interested in learning a little bit more about how the government reacts to recessions, well, if you're in the year 2020, all you got to do is listen to the news. But if you want to learn a little bit more about history and things of that sort, then I have a couple of videos about that already that you should be watching. Now, the main reason why the government today is so much active is because of the Employment Act of 1946. The Employment Act of 1946 basically commits the federal government to foster and promote conditions to promote maximum employment, production, and purchasing power. In other words, it commits the government to creating the conditions for economic expansion. And before the year 1946, it was not the role of the government to do that. So it was sort of hands-off kind of behavior by the government. Since the 1950s, the government has become a much active participant in economic recessions, especially during the downturn. Um, the biggest thing that the government has created, by the way, it's a sort of social safety net, we like to call it. So it's a set of programs that are basically created. And by the way, I am trying to draw a net here. And as you can see, I'm not very good at it. Okay. But the government has created all these social safety nets that what basically do is they catch you as your income decreases. So we have things like unemployment insurance, welfare, food stamps, and expansions in unemployment insurance, etc., etc. Things like Medicaid, which is health insurance for the poor. So all of these social programs today do not allow somebody's income to go from something to zero. It goes from something to less than something, but not all the way down to zero. Okay, so in any case, this is really the biggest thing that we have today, saving consumption in the US economy. All right. I hope in this particular chapter you learn a little bit more about how the financial system works, what does it do, what are the business cycles, and economic growth in general. And this is another class by Professor Choi. Have a good one.